Federal Reserve officials at their most recent meeting expressed little appetite for cutting interest rates anytime soon, particularly as inflation remains well above their goal, according to minutes released Tuesday. The summary of the meeting, held October 31, November 1, showed that Federal Open Market Committee members still worry that inflation could be stubborn or move higher, and that more may need to be done. At the least, they said policy will need to stay restrictive until data shows inflation on a convincing trek back to the central bank's 2% goal. In discussing the policy outlook, participants continued to judge that it was critical that the stance of monetary policy be kept sufficiently restrictive to return inflation to the committee's 2% objective over time, the minutes stated. Along with that, however, the minutes showed that members believe they can move on the totality of incoming information and its implications for the economic outlook as well as the balance of risks. The release comes amid overwhelming sentiment on Wall Street that the Fed is done hiking. Traders in the Fed funds futures market are indicating virtually no probability that policymakers will increase rates again this cycle, and in fact are pricing in cuts starting in May. Ultimately, the market expects that the Fed will enact the equivalent of 4/4 percentage point cuts before the end of 2024. However, the minutes gave no indication that members even discussed when they might start lowering rates, which was reflected in Chairman Jerome Powell's post-meeting news conference. The fact is, the committee is not thinking about rate cuts right now at all, Powell said then. The Fed's benchmark funds rate, which sets short-term borrowing costs, is currently targeted in a range between 5.25% to 5.5%, the highest level in 22 years. The meeting occurred amid market worries over rising Treasury yields, a topic that appeared to generate substantial discussion during the meeting. The same day, November 1, when the Fed released its post-meeting statement, the Treasury Department announced its borrowing needs over the next few months, which actually were a bit smaller than markets had anticipated. Since the meeting, yields have receded off 16-year highs as markets digest the impact of heavy debt-fueled borrowing from the government and views over where the Fed is headed with rates. Officials concluded that the rise in yields had been fueled by rising term premiums, or the extra yield investors demanded to hold longer-term securities. The minutes noted that policymakers viewed the rising term premium as a product of greater supply as the government finances its huge budget deficits. Other issues included the Fed's stance on monetary policy and views on inflation and growth.